Two people can retire with the exact same pension, and one will lose tens of thousands more to tax simply because they take their money in the wrong order. Let me ask you something. You've been disciplined. You saved when others spent. You built a pension. You put money into your ISA year after year. You did the things you were supposed to do. And now, retirement is either here or getting close. At this point, people assume the hard part is done. It isn't. The decisions you make when you stop earning, about which pot to draw from first, how much to take each year, and in what order, those decisions are just as consequential as everything you did on the way up. In some cases, they matter more. Two people with the same pension pot, the same ISA balance, and the same retirement ahead of them. One pays tens of thousands more in tax over the course of their retirement than the other. Not because they invested differently, not because they earned more, because of the order they withdrew their money, and because of the decisions they made, or didn't make, long before they got there. My name is Mark. Welcome back to Wealth Architecture. In the last video, we looked at how to structure your income while you're working. Today, we look at the other end. What happens when you start drawing it back out? How the pension and ISA work together in retirement. What most people get wrong, and what you can start thinking about right now while there's still time to shape the outcome. There is the one thing most people don't realize until they're actually in retirement and drawing their money. Your pension is not a tax-free pot. It is a tax-deferred pot. The money went in before tax was paid. The growth happened free of tax. That part is excellent. But when it comes out, when you start living on it, most of it becomes taxable income. HMRC treats pension withdrawals as taxable income, much like a salary. They get added to everything else you earn in that tax year and taxed at your marginal rate. You can take 25% of your pension pot as a tax-free lump sum. That is a genuine benefit. But the remaining 75%? Fully taxable when you draw it down. Now, for most people, that is still a good deal. You received 40% relief on the way in. You might pay 20% on the way out. The maths still works in your favor. But here is where it starts to go wrong. If you draw too much from your pension in a single year because you want to fund a large purchase, help a child with a deposit, or simply because you haven't thought about the sequencing, you can push your total income into a higher tax band. Money that was sheltered at 40% on the way in then gets taxed at 40% on the way out. The advantage disappears entirely. Your pension is not a gift from HMRC, it is a negotiation. The terms of that negotiation are set by how carefully you withdraw it. Most people never read the terms and conditions. They just assume it will be fine, and it often isn't. This is where the ISA earns its place in a retirement plan, not just as a savings vehicle, but as a tax management tool. ISA withdrawals are not income. They do not appear on your tax return. They do not push you into a higher band. They do not affect your personal allowance. They do not count toward your adjusted net income. In the eyes of HMRC, they are completely invisible. You can withdraw £50,000 from your ISA in a single year, and HMRC sees none of it, not a single penny. That invisibility is the point. In retirement, the ISA gives you a source of money that simply does not exist in the tax system, and that means you can use it to fill the gaps. The years, or the amounts, where drawing more pension would push you into a higher tax band. The ISA steps in instead, and HMRC doesn't see it as taxable income. Used together, your pension and your ISA give you something genuinely remarkable. The ability to control your taxable income in retirement, year by year and pound by pound. Used separately or drawn in the wrong order, you lose that control entirely. Let me show you what this looks like in practice. Two people, both 65, both retired, both have built exactly the same pot, £400,000 in a pension and £100,000 in an ISA. They each need £40,000 a year to live on. The first person is David. David draws everything from his pension. It is simpler that way. It is what he has always assumed he would do. He takes his 25% tax-free lump sum up front, that is £100,000, and then draws £40,000 a year from the remaining pot. The second person is Susan. Susan thinks about the structure first. She takes a smaller tax-free lump sum to begin with, preserving more of that tax-free entitlement for future years. And rather than drawing her full £40,000 from the pension, she draws £25,000 from her pension each year, keeping herself inside the basic rate tax band, and supplements the remaining £15,000 from her ISA. Both of them have £40,000 a year to spend. Same lifestyle, same retirement, same starting pot. Now, here is what happens to their tax bills. David's taxable income each year is £40,000. After his personal allowance of £12,570, he pays basic rate tax on the rest. His annual tax bill comes to roughly £5,486. Susan's taxable income is only £25,000, just the pension portion. The £15,000 from her ISA is invisible to HMRC. After her personal allowance, her annual tax bill comes to roughly £2,486. That is a saving of £3,000 every single year. Over a 20-year retirement, that's roughly £60,000. Same pot, same lifestyle, £60,000 difference. David is not doing anything wrong. He's saved well. He built a pension. He is doing what most people do. Susan is doing something different. She is managing her taxable income in retirement the same way she managed it while she was working. That one habit, that single discipline, is worth £60,000 over the course of a retirement. And that figure assumes no state pension, no other income sources, and no changes in tax thresholds. In practice, for most people, the difference is larger. In reality, most people will also receive a state pension, which uses part of your personal allowance and increases the importance of managing how much pension income you draw each year. So how do you actually do what Susan did? It comes down to 3 principles. Not rigid rules, principles. Because the right answer will be different for everyone, depending on their pot size, their state pension, their other income, and the life they want to live. Principle 1. Never draw more pension than you need to in any given year. Every pound you draw from your pension is a pound of taxable income. If you need £40,000 to live on, and you have ISA money available, the question is not, how much should you draw from your pension? The question is, how much pension can you draw before you hit the next tax band? And can you fill the rest from your ISA? The same discipline that applied when you were earning applies just as powerfully when you stop. Principle 2. Use the ISA to absorb the gaps. The ISA is not a backup fund. In retirement, it is a precision tool. The years where drawing more pension would push you over a tax threshold, use the ISA. The years where you have a large one-off cost, a house repair, a car, helping a child buy their first home, use the ISA. Its invisibility to HMRC is most valuable precisely when your pension income would otherwise tip you into a higher band. That is when you reach for it. Principle 3. Plan your tax-free lump sum deliberately. 25% of your pension pot can be taken completely tax-free. Most people take it all at once the moment they retire. That is not always the most efficient approach. Taking it gradually as part of each year's drawdown, with 25% of each withdrawal coming out tax-free, can smooth your tax position across many years, rather than creating one large tax-free event followed by years of fully taxable withdrawals. How you take your tax-free entitlement is a decision, not a default. And like most decisions in this area, it has consequences either way. There is a pattern running through every video in this series. The people who end up better off are not the ones who earned the most. They are not the ones who picked the best investments or took the most risk. They are the ones who understood that every financial decision has a tax dimension, and who made that dimension part of their thinking every single time. On the way in, you structured your income to minimize what HMRC sees. On the way out, you structure your withdrawals to minimize what HMRC takes. Same principle, two different phases of the same life. And this is where most people get caught out. The system doesn't just reward effort. It does not reward hard work or loyalty or the years you spent saving. It rewards understanding. It rewards knowing which lever to pull and when. You now have that understanding. Most people you know still don't. If you are 10, 15, or 20 years away from retirement, this is the video to act on now. Because the options that Susan had, the ISA balance, the pension balance, the flexibility to choose which source to draw from in any given year, those were not built in the 5 years before she retired. They were built over decades. You cannot create them at the last minute. The decisions that give you control in retirement are made now, while you are earning, while you have the time and the income to shape the outcome. So here are 4 questions worth sitting with this week. Are you building both a pension and an ISA, or are you relying on just one of them? Do you have enough in your ISA to give you real flexibility when you get to retirement? Do you know roughly what tax rate your pension withdrawals will attract? And have you ever worked out how much pension income you could draw each year before you would tip into the 40% band? These are not questions for when you retire. They are questions for right now. That is the foundation tier complete. 5 videos, 1 framework, your income in the right order, the right tax wrappers used correctly, the 60% trap understood and dismantled, and now the full picture of how to draw it all back out without handing more to HMRC than you need to. From the next video, we go deeper into the expansion tier, the angles most high earners never consider, the hidden mistakes, the overlooked decisions, the things that look fine on the surface but quietly cost thousands every year. Video 6 is about the 60% rate again, but not the way we covered it before. This time, we go through exactly how to avoid it, not reduce it, not soften it, eliminate it. If that sounds worth knowing, subscribe and bring someone with you who needs to hear it. I'll see you in the next one.